All right, let's go ahead and get started. I'm going to share my screen. Yeah, just if you could, please let me know in the chat just to make sure that you guys are hearing me, you're seeing the screen, and it looks good. Just let me know. Alrighty. All right, Charles, I want to kick us off. And just before we dive into this quarter's deal flow, let's just take a step back and introduce this concept. You know, what we do. We do this webinar every quarter. So, Charles, you want to just explain what this is?
Yeah, so this sheet, it summarizes, a lot of the deals that we've underwritten, and it shows, key statistics about each one. So I guess starting from the left, what market the deal is in, whether it was in a marketed process or off market, how many units it is, what vintage it is, square feet per unit. So just the physical stats, and then the pricing information, price per door, both what we want and then essentially it's a comparison between, in all the different metrics of what the market asking price is for things, and where we come in, what we value things are, what we think makes sense to make deals. So you've got the guidance price per door, and then our price per door, guidance price per square foot, our price per square foot, guidance price in dollars, our price in dollars, and then cap rates, valuation metrics at those prices as well. And then IRRs at those prices for the guidance price and our price. And then just the underwritten NOI per unit, both going in unstabilized, which kind of supports the cap rate calculation, but also it's just an interesting metric. And then capex, obviously, for each deal gives you a sense of, well, what the capital needs are, and also maybe what kinds of plans you're looking at given a specific deal. Obviously, if it's higher, it's going to be a riskier plan with doing more. If it's lower, it will be a more conservative plan doing less.
Yeah, so even if you weren't in our position and knew these deals intimately, you would still be able to look at this data and, like Charles said, understand kind of better what these deals look like because you have the capex budget. So a bigger capex budget, as Charles said, is obviously a bigger value add deal. And so you should expect a higher yield on cost for that sort of scenario. You could also expect a lower going in cap rate when you are buying a bigger value add deal. Obviously, if there's more meat on the bone, then typically the deal prices at a lower cap rate because of the embedded upside. So when you look at kind of the cap rate data, which is kind of the first thing, the main thing that we and everyone else focuses on in regards to this data, obviously not all deals are the same and not all cap rates should be looked at the same, right? There are good deals at a 3 cap and there are bad deals at a 5 cap even. So cap rate isn't the end all be all. So it's important to give the cap rates context. But with that being said, let's just kind of dive right into that topic because that's what a lot of us really care about, and kind of cover the cap rate situation. So as you can see, and if you know what we do, we're very focused on the Texas market, particularly Dallas, Fort Worth, and Houston. So you can see the majority of the deals we underwrote this quarter were in Houston, and a lesser amount in DFW. But the average cap rate at the pricing guidance, meaning the price that we were guided by the broker, the strike price, the whisper price, right? You can see here are the cap rates that we underwrote for this data set, which has an average cap rate of this quarter of 3.2%, which is roughly in line with the cap rate for the previous quarter of 3.1%. So, it's a very small difference, 3.1 to 3.2. We're not really reading into that. You could imagine that cap rates should go up because of all the upward pressure from interest rates. But based on research reports, there's only a 70% correlation between cap rates and interest rates. And I say only, I mean, 70% is pretty high. So logically, you would imagine that cap rates will go up because of interest rate rises, but it is not really showing in the data. What are your thoughts?
Well, I mean, it's also kind of just a market dynamics. People aren't gonna, the interest rate's gonna go up first, and the pricing might lag. And for example, right now people are thinking maybe there'll be a bit of a freeze where the sellers won't want to sell. So there's just going to be a bit of a gap there, and so the cap rates, if they're transacted, will stay low, but maybe there just won't be as many transactions.
Yeah, that's what we saw during COVID. We, as everyone else experienced, likely on this call, there was not very many deals happening during COVID. And people were looking for that COVID discount. Sellers weren't really offering it. And therefore, not a lot of deals got done. So did prices really go down in that moment in time? Yeah, maybe if a deal were to have sold, but really not much traded. Something interesting to point out is if I just highlight the Houston data, the average cap rate is 3.4% in the data, and DFW, the average cap rate is 2.9. So as expected, there's about a 50 basis point difference between the markets as far as going in cap rate. And that's, Dallas gets more love. Dallas has the headlines. It's more money wants to be in Dallas. I think that is the contributor to the sub 3% cap rates in Dallas and the slightly better value in Houston. So nothing surprising there, but it's good for that to show up actually in the data rather than us just kind of telling ourselves, well, Dallas is expensive and we like Houston and it's a better value. It's showing up in the data.
Right. I mean, it could also, signal like a perception of lower risk in Dallas. I don't know, or maybe higher growth prospects.
So before we move on to other insights, I just want to make sure that everyone is feeling good on this. Any questions, confusions about the numbers in front of us, or want us to kind of cover anything in particular, just please let us know in the chat or unmute yourself. And we have we've had lots and lots of comments and conversations on these previous webinars, so we welcome that again. Question came in about the spread. Kind of looks the same for DFW in Houston. So is the risk return there? So yeah, so let's analyze more than just the cap rate data. Let's look at the yield on cost data and that kind of thing. So to set the stage, let's look at, well, first of all, just the average yield on cost, 5.2%. Charles, you want to define yield on cost?
Well, yeah, it's the projected NOI over the total capex plus purchase price. So the total capitalization of the deal. It's like a cap rate on the full capitalization of the deal.
Yeah. So the yield on cost is kind of the best metric. Cap rate is incomplete and yield on cost is very close to complete because it takes into account the future and it takes into account your business plan. So it doesn't really matter where you buy, it matters where you end up. And so that's your yield on cost is a pro forma number there. So you can see the average yield on cost is 5.2%, which is very slim. I mean, it's doable, but quite slim, just given where the cost of debt is today. You can't really lever up a 5.2% yield on cost too much. So let's kind of dig in between the differences in the markets and whatnot. So the yield on cost that we have at the guidance for Houston is 5.4, and then the yield on cost is 4.9. So as Penn mentioned, well here the yield on cost spread is the same as the cap rate spread. Both are 50 basis points, and that means that the spread, which is here, this column, and it's just defined as the difference between the yield on cost and the cap rate, the spread is the same. And the spread should be the same because the spread is basically your business plan. Also, spread is in our definition, it's an untrended number. So yield on cost is untrended. We don't trend our yield on cost. And what that means is we don't look at year 2 or year 3 and layer on levels of growth to get to this yield on cost. This is a static or untrended yield on cost. So aside from trend, because there's no trending here involved, the spread should be the same, because the spread is your pure business plan. You're raising rents, you're spending money, you're raising occupancy, you're improving management, you're reducing expenses, whatever it is you're doing in your business plan to get to your yield on cost, that's really showing up in your spread. And it's not, spread should be the same everywhere. It's not that you're going to necessarily get a bigger spread in a different market, right? Markets are roughly the same as far as how you can raise rents based on the renovations you do and occupancy improvements and that kind of thing.
I mean, the spread does get, the bigger spread indicates a bigger plan, and a lot of the time, if you have a bigger spread, you probably needed that because you had a lower going in cap rate. So to make it make sense, you're going to need to do more work.
Right. I mean, here's a deal where they're offering the deal at a 2.5 cap, which is a low going in cap rate. And so you need a big spread just to get to a 5% yield on cost, which 5% yield on cost is not good enough in many cases, right? You have to be in a very strong market to accept that low of a return. And furthermore, as Charles said, a big spread is an indication of a big plan, a big and bigger risk, right? The more spread you have, the more uncertainty that you don't hit your plan. So the thing about spreads is the bigger they are, the more you need. So the bigger the risk, the higher the yield on cost that you need to justify the risk, right? Why would I buy a 2.5 cap deal if I'm only going to stabilize to a 5, right? If I'm only going to stabilize to a 5, why don't I buy something that is less work? So that's the idea about spread and yield on cost. However, the thing I talked about with trending is if these were trended numbers, right, you could make the argument that DFW is a hotter market, right? At least that's what people believe. A lot of investors believe that. So you could imagine that, well, I'm willing to accept a lower return by way of a lower going in cap rate and by a lower yield on cost because I'm relying on the growth, the ostensibly superior growth. So that's the story there. Bo is asking about hitting your returns when the gap between cap rates and interest rates are or can be 100 basis points or more. So yes, I mean, obviously, the bigger the spread is between your cap rate and your debt, you're going to have better cash flow and makes everything better. So yeah, I mean, deals are harder and harder to do these days. It's been a trend for a long time, and yeah, I don't know. There's no magic pill to fix that issue. It's just I mean, this brings us to, I guess, kind of, in my opinion, the major insight of the previous quarter and the market that we're in today, which is that based on the way we're underwriting, we're really finding ourselves constrained by cash flow and not by IRR. The two main things that we look at when pricing a deal are the IRR, right? It has to meet our minimum IRR need for that deal, and cash flow, right? Just because a deal has a good IRR doesn't mean we'll buy it, right? It also has to have good cash flow. And just because a deal has good cash flow doesn't mean we'll buy it, because if it doesn't have strong total returns, it doesn't make sense. So what we're finding is IRRs look pretty good today, but because interest rates have come up so much, they're really squeezing, and cash on cash is just really, really squeezed. So we're getting maxed out on pricing because of cash flow, cash on cash, not because of IRR. Anything to add?
Well, yeah, I mean, the rates have gone up, interest rates on the bridge debt that we've been using, that people have been using to buy the deals, has gone up a lot. And, the cap rates haven't given much. So, obviously that margin has shrunk a lot, and it maybe is negative in a lot of cases, if you're not the most optimistic guy.
Yeah, so it's a good point, and yeah, pretty much led us nicely to our cash on cash insight. What insight do we want to jump to next?
Well, I mean, we could kind of wrap up that insight. I mean, there's the kind of, so the cash flow is the limiting factor. And so, the IRR is there, but like that's assuming that, the cap rates that you exit to are going to remain somewhat unaffected, by the ongoing shift. But,
yeah, that's
so
really what's happening here is it just depends on your underwriting methodology, right? And the thing about the reason why the IRR still looks good is because we're not changing our underwriting methodology. Yes, if I were to, I mean, really, I don't want to bet because there's so much uncertainty and you never know the future. But it does feel like it would make sense for cap rates to go up. But there's strong arguments for why cap rates will not go up, even with interest rates going up, such as growth, inflation, and opportunity cost of capital, right? A lot of money wants to be in real estate always, and even more so because of the current dynamics in the market, right? People want to go to cash flow assets, people want hard assets, they want inflation hedged assets. So there's more money that wants to be in real estate. More money coming into the market drives down cap rates in spite of higher rates. Also, if people are expecting inflation and expecting growth, then they can also bet on future increases in NOI and therefore accept a lower cap rate today. So you can make those arguments as to why cap rates should stay low. And also, of course, you can do the flip side and make the argument. But the point that we're trying to make is, as far as underwriting methodology, we want to keep our exit cap rate methodology consistent. We don't want to just say, well, today, we feel that cap rates are going up, so we're going to change the way we underwrite our exit cap. And then tomorrow we're going to wake up and think, you know what? I think cap rates are going to head down, and then we change it, right? The key is consistency, right? Are we right when we underwrite? I mean, we think so, but there is no right. There is just your way, and you want your underwriting obviously to be defensible and make sense. But I think a really important factor is consistency. You want to underwrite in a consistent fashion. So if you always underwrite a certain way and something is kind of always a bit aggressive or something like that, fine. That's not a problem because you do it consistently across all your deal flow, and therefore you basically have a situation like what we have, which is this data in front of you, and out of all these deals, you're able to pick the best one because it's a relative decision. It's not an absolute decision, right? It's not necessarily, hey, I'm going to buy every single deal that meets this number criteria, and it doesn't matter what it is, right? It's a relative thing, right? We've got this bucket of deals, and we're going to pick the, top 3 deals out of this bucket that we like. So that's the methodology. It's a relative analysis, not an absolute. Dylan's asking about sharing the spreadsheet. We have a blank template of this spreadsheet. So we won't share this exact spreadsheet, but we do have a template. And if you go to our website, LSCRE.com, let me just put it in. If you go to our website and you download the underwriting model, you'll get an email with a link to our underwriting model, as well as this template spreadsheet. So hopefully that's helpful.
Can people actually read this sheet with the zoom size the way it is?
It's a good question. Is it helpful if we made this bigger? I'd imagine it would. Okay, yeah, works for me. All right, so yeah, so no one's really asking the question, but we'll kind of quickly share why don't you share our exit cap rate methodology?
Basically, in Houston, for at least the recent past, it certainly made sense, and I think currently in the market, it hasn't shifted yet, is basically, we'd say maybe 5 cap for kind of the worse and older product and stuff, and maybe 4.5, for the upper end of what we would do, which would be kind of like a, early 2000s, B plus, A minus type deals in better areas.
Yeah, and we have this data, right? So we look at, okay, the average cap rate is maybe 3.5%, right? And then from there we say, well, if today the cap rate's 3.5, we can kind of go up about 100 basis points to 4.5 and feel pretty good about the exit. So that's kind of roughly the math. We don't do anything like 10 basis points per year or anything that precise, right? So what are your thoughts?
Well, I mean, I think if we were to magically find a deal that had an amazing going cap rate for some reason, we would probably want to have some spread, so at least 50 basis points, maybe 75 basis points over the going in. Um, but as it is, like 450 or 500 is, quite a lot over the going in these days.
Right. Okay, we have another question about low housing supply. How can this be bad? Doesn't it just make real estate more desirable? Yes, absolutely. It's bad for America. It's good for landlords. I mean, it's affordable housing is a problem, and it's you have to build more of it, and it's not a bad thing for rents. Bo is asking about our exit cap rate is the same regardless of hold period. Yes. The only two hold periods that we underwrite are 3-year hold periods and 5-year hold periods. And we don't factor the hold period into our exit cap rate. We can go into more on that if you like. So Mark is asking about recent sale comps and how we rely on them to cross-check our exit cap rate. So that's a good question. We actually got that on a deal yesterday. So my thinking is cap rate data is very nebulous. So you can't really trust, like, if I tell you, oh, that deal is a 3.5 cap, it's essentially meaningless to you because you don't know how I underwrote the deal. You don't know if I included reserves. You don't know if I adjusted for future taxes or an insurance. You don't know if I'm light on my payroll, heavy on my payroll. So cap rates are so subjective. So it's really, in my opinion, I mean, it's not a bad thing to have the data, but it's not that helpful to go and to CoStar or ask a broker to provide you, the cap rates for the sales, for the recent sales. That's why we have this, right? We have our own internal data, which act as somewhat of sales comps for cross-checking our exit cap rate.
I mean, I think you're never going to be able to find or you're going to really struggle to find a sales comp that's going to justify, that's going to be your exit price, right? Because you're paying the most in the present to win the deal, and you're not going to find that's the future. So you might find a comp that is in line with your purchase price, but you're probably not going to find a comp that's in line with your exit price. If your purchase price makes sense in line with the comps, then at least you're not getting a bad deal relative to the market. And I guess cap rate data is nebulous, but basis in just absolute dollars a door or dollars a foot, those would be a thing you might look at. And so if your model, if your exit price a door just seems crazy, you might want to reconsider your assumptions, either operations or exit cap, and based on that's not really sales comp, but that's just kind of like your gut feeling of this just looks too aggressive. But I think the dollars a door and dollars a foot sales comps make sense.
Yeah, I mean, it sure would be nice if you could buy a deal at a legitimate discount and there's a deal down the street that is a renovated sales comp that already sold for the price that you want to sell for, but that those just don't exist. That's wishful thinking. I shouldn't say they don't exist, but they're much worse than a needle in a haystack. It is very tough. And also, especially if you're trying to buy big deals that have a lot of eyeballs on them, it's, there's no secrets. You're not just going to sneak off with a $50 million deal that traded at a 20% discount and you're able to just quickly renovate it and then sell it for what the deal sold for next door. There is an implicit bet on the future. All right, so we got some more questions coming in. Really appreciate that. Let's knock through these and then we'll dive into another insight. So question about prepayment penalties, assuming 7-year fixed rate debt or a 1-year extension, 3-year bridge. Not totally understanding the question, but so I think what the question is asking about is tying in hold periods to financing. So if we're going to use fixed or 10-year perm debt, like an agency execution, then we will underwrite a 5-year hold. And we typically in that case would do a floating rate loan, which will allow us to exit for 1% prepayment penalty at any time. So that's very good. And that ties in well with the 5-year hold. When we do a bridge loan, we underwrite a 3-year hold because we make the underwriting period of 3 years coterminous with the initial bridge loan term of 3 years. That's typical bridge loans are 3-year initial term plus 2 1-year extension options. Another question is about rental demand dropping in the future in hot markets as wages don't keep up with raising rents and tenants get priced out of the market. I do worry about that. I do think about Phoenix as an example, which has seen unbelievable rent growth. We're getting off topic here, but right, rents have gone up, I don't know, maybe 35%, 40% since COVID. And obviously wages did not go up that much, but Arizona or Phoenix was coming from an affordable starting point. So that gap has been largely closed now. And so I think about Phoenix's rents relative to San Diego's rents, and I think, wow, that's pretty similar, right? Before you had a lot of people leaving California, going to Phoenix because it was a cheap alternative and they could have a higher quality of life. Now people are in Arizona thinking, well, for about the same price, I can go live on the beach. So I think that is a risky, it feels a bit risky in that run has been made and that there just can't be that much more room to run, which I think it is valuable to look at the percent of income that people in the market pay to rent, right? And it's different all across the country. Miami is famous for being known as being one of the most, I mean we're here in New York, right? Super rent burden. People pay half their income to rent. And same as in Miami. In Miami, rents are cheaper. And like you get why people pay so much of their income to rent in New York, because New York's cost of living is super high. But in Miami, rents are cheaper, yet there's just still whatever this culture where people are paying 50% of their income to rent. Places like Albuquerque, they're paying 20% of their income to rent. So think about, there's more room to run. It doesn't mean it has to go up from 20 to 50%, but there's some slack there, and that you could see some rent growth gains coming from not necessarily from income growth, but from a higher percentage of income going towards rent. Going back to sales, Kenneth is asking about Texas being a non-disclosure state. Are you able to purchase price data for deals that you don't buy? Yeah, we can ask brokers and get their data about sales.
Yardi and CoStar also have sometimes of varying accuracy.
Yep, you can get loan data, which gives you a better idea. You can guess to what the price is based on loans.
Well, I mean, this isn't really about comparability to CoStar, right? I mean, this is just a snapshot into our process. It's kind of subjective to us. And, you know, if there's a reference point, it wouldn't be CoStar, it'd be like our last quarter's underwriting and kind of how it's different from that, or how it's, you know, because everyone does it differently. And, you know, also like CoStar, like, oh, we got a 5. I mean, I've never seen a 5 cap when CoStar said it was a 5 cap. I mean, it's,
well, I mean, I would take it a step further and say that for our purposes, this is way better than CoStar. This is very valuable data. But like Charles said, it's just a snapshot into our process. This data could be valuable to you. It could not. This is why we encourage everyone to build this for themselves. You know, if you are actually underwriting deals every day in particular markets, because having these insights can be very valuable to help you understand what actually is a good deal in the market and what is not. That's kind of at the end of the day what makes sense. But I kind of want to elaborate a bit more how our data would be better in terms of what CoStar is providing. Yeah, so it's more accurate, right? Like Charles said, CoStar cap rate data at least is highly unreliable. It's just not accurate.
well, CoStar's everything data is not that accurate, right? I mean, like their rents are sometimes off. Like they have data on every property in the market. They don't have that. We actually get this information from either the property or the broker, who got the information from the owner. Especially on pricing, it's hard to be more accurate really than stuff, what you actually got from the broker, what you priced it at. This is based on financial statements. I don't think CoStar has got financial statements that they're basing their numbers on. But yeah, I mean, it's relevant to us. It's not really relevant to, other use cases necessarily.
Yeah, I mean, we're not selling this data. We're not trying to compete with CoStar. Even though we didn't say the nicest of things about CoStar just now, we like CoStar a lot.
Well, it's a great like CoStar is great if you're relative comparison between things, right? Like it's a yardstick.
Yeah, it's very good. Okay, so really quickly, we did not walk all these properties. Penn asked about walking all these properties. No, we did not. Charles actually just got back from Houston late last night, and you did tour 11 properties.
I did tour 11 properties.
11 properties in like a day and a half. That's very impressive. But that is not all. That is not all these.
Yeah. That would be all we'd be doing.
Yeah, but we actually do tour a good amount of these.
Well, if we get to a successful bid or near a successful bid, we'll tour, right? But I mean, this is a list of deals you underwrote, and a lot of them are not good deals that we weren't really interested in pursuing that much further.
Yeah, the reality is most deals, it's best to spend less time on them than more. And that's kind of goes into a good, I think we can maybe talk about this really quick, which I think is interesting about your pipeline and how to allocate your resources, right? Because you only have a finite amount of time to underwrite deals. So how do you want to allocate that time? Do you want to underwrite everything you see? Do you want to spend a ton of time on every single deal and miss out on some? Obviously those are not the right things to do. The right things to do is to kind of tighten up your box and only spend time on deals that are worth spending time on, and finding smart ways to immediately pass on deals before spending any time. So it's really an art. It's very challenging because it's so tempting to look at deals because you just have FOMO. You don't want to miss out on a deal because you just dismissed it because on its surface it didn't look good, and then turns out later it was. So yeah, it's an ever evolving situation as far as how to allocate our time as far as pursuing deals. Like Charles and I were talking this morning about how being in best and final processes are time consuming, and you can't do everything. You can't tour property, be in a best and final, talk to brokers, underwrite deals, right? You just can't do all of it. So you have to we have to allocate our time wisely. So what are your thoughts about the pipeline?
Yeah, well, and also like if you think a deal is interesting, it's a competitive environment, and you might want to take some extra time to dig in on how to actually win the deal. You're not typically going to be able to. You can pause quickly if it doesn't make any sense, but you might be close, and then to get that last 10% or less than that, last 1 or 2% that will take you over the last bidder, you might have to do a lot of homework, look at a lot of comps, really get comfortable, because each assumption you need to have a pretty tight range and be accurate on it to be able to be competitive, if it's a deal that you think makes sense to do that on. So
yeah. And then as far as walking properties, so Josh, our asset manager, sits here in New York. We've got 7 of us in New York, 3 of us in Houston that run our property management business. So yeah, we have people in Houston that are local that work in our management company, Radiance Living, that can tour property for us, and they do that. So it's very helpful. As far as our win ratio, I would say it's slightly better than 1 out of 100.
I was going to say 1 to 2% maybe.
Yeah, 1 to 2%. 2% is very good, right? That means you're getting 1 deal out of 50 underwrites. I would say that's actually probably where we're trying to get that number up, right? The way that we all want to do more deals, right, in this business. So the way you do more deals is, 1, you can underwrite more, right? You can increase the denominator, or you can increase the numerator and up your win rate. So in terms of working smarter, not harder, upping your win rate would be very, very powerful. So finding ways to do that is very worthwhile. Yeah, so Charles here pointing out our Q1 key deal metrics. So the bid ask spread, which means seller wants this price, we want this price. That's the bid ask spread. So you can see the average deal, right? 50th percentile, there's an 8% bid ask spread, which is pretty wide. The deal is not getting done. Now, if you get to the 90th percentile, okay, yeah, price isn't an issue. So the reason we're not buying it is maybe in the end, we didn't, we toured it, we didn't like the area, or we lost the bid because they picked another buyer because of terms or relationship or something like that. So yeah, so you can
Also, these are based on guidance prices, and sometimes the guidance is exceeded in rounds of bidding. So that's also sometimes what happened here.
yeah, especially lately, deals have been trading sometimes well in excess of the guidance price. So some of this cap rate data, so I mean, a lot of this data that's based on guidance pricing is potentially unreliable because this guidance pricing, as Charles mentioned, is the strike price. But then once you go into a bidding war and multiple best and final rounds, the winning bidder actually pays a whole lot more than the guidance. The data that is not unreliable is our pricing, the LSC pricing. And with this is just basically the price that we would buy the deal at, right? So you can see this seller or the guidance is a 3.5 cap. And for us, we'd like the deal to 4 cap. No surprise. So how often are you finding deals that look great, good in Houston and DFW? I mean, it's kind of similar to our win rate. I'd say 1 out of 50, right?
I think it's so far it seems to be easier in Houston, but maybe we just gotta get more.
We need to work harder.
Yeah, but I mean it's I think like the kind of off market, whatever. I mean those deals are really expensive all the time. They might they're just like, yeah, you can have it if you pay us an insane number. And plus like some of those are fairly well exposed as well. They're just not quite as exposed as widely marketed deals. So I mean it's always tough.
Okay, so let's answer these questions and then let's kind of cover some more insights. So as far as easily passing on deals without spending unnecessary time, is this criteria, location, or back of the envelope analysis? Yeah, good question. So we don't do a back of the envelope. When we decide to underwrite a deal, we're fully underwriting it. So that's time consuming, and whatever we can do to pass before deciding to do that is very beneficial to our process. So we look at things like the location, the incomes, the rent growth, just things that are more qualitative about the location and the property, such as its vintage, meaning the year it was built, and its infrastructure, right? We're going to skeptically look at a deal that's 100 units built in the 60s with a boiler and a chiller. We probably will just pass on that right away. Also, something that we haven't touched on yet, but is related to the data in the tracker, is deal size, right? It's a lot easier for us to pass on a $15 million deal than it is a 40, right? 40 is much more interesting to us and worth to spend our time on. We really don't want to do a $15 million deal. We would have loved to do a $15 million deal, I don't know, a year or so ago, but we're growing and times are changing. So we have to allocate our resources, right? Even if we hit our goal of, let's say, buying 8 deals in a year, which would be fantastic. Let's round it up to 10 just to make the math easy, right? If it's $15 million deals, that's only $150 million of deal volume, and that's not meeting our goals. So, it's not about, there's only so many deals we can do in a year, and we have to hit our volume targets.
I mean, if the numbers make sense the same way, right? And the dollar size is larger. You're just getting, more money for your labor. So, I mean,
yep, that's why this business is so good. Yeah, scalability. Penn's asking about core plus and value add. These are core plus and value add deals. And the way that you can kind of figure that out is by looking at the going in cap rate, right? Core plus deals.
We're not really core plus buyers.
Yeah.
I think there are actually a couple in there that have like a 13 that we solved for, but we wouldn't actually be able to. Yeah. So these 2 here, I said our equity wouldn't accept this return. Project 15, Project 15, like these were really nice, big new deals, but you know, like someone probably is going to buy it thinking that, but it won't be us.
Yeah, that's the trouble. I mean, we're going to continue to grow and build relationships and build our track record. And but with that being said, today we don't really have the confidence that if we showed investors a good deal that's, let's say, core plus, it's class A, it's newer, it's nicer, and it only was a 12% IRR, we don't have the confidence that we would have investors to support that. Our investors and most people's investors want mid to high teens returns. And even if it is a good deal, because it's new and low risk and great location and all that, if the returns are 12, even if that's good for that kind of product, it's just not going to work. So we'll get there eventually, right? We think those are good deals, but we're not yet ready to take action on those.
Well, yeah, I guess so. Kind of apropos the discussion of kind of the the box and how do you spend your time efficiently, and how are things changing, right? So as I was saying, we are working to focus on bigger and better deals and stuff, and so you can kind of see that showing up in comparing this current quarter with the previous quarter, maybe in Houston. So our unit count, Q1, we averaged 352 units underwritten versus 278 per deal last time. Our vintage has gone up by 4 years to 1981 on average. Price per door has gone up as well. So that you can see it's not just that like we're getting more aggressive, because we're actually about 10,000 a door cheaper than the guidance in both cases. Both Q4 we were at 100 versus 110. And now in Q1 2022, the guidance is 128 and we're at 119. So we're still kind of about the same level relative to the market, but we're looking at deals that have got higher price per door and higher price per foot. And part of that might be market growth, but it's also like the vintage is getting, higher, and we're looking at higher quality product. We're filtering out the stuff in worse areas with, questionable aspects to them that we don't find that attractive. So yeah, you can see that efficiency at work in like the deals we're targeting now.
Absolutely.
Oh yeah, actually, so just to add, so yeah, so last quarter we looked at 48 Houston deals, and of those, 56% were above 25 million. And then this quarter we looked at slightly more actually that were over 25 million. So we looked at, but 81% of the deals we looked at were over 25 million this quarter. So we're really trying to, we're still looking at small ones selectively if maybe they're off market and we think they have an interesting story, but in general, that is the move we're trying to make.
So Kenneth is asking about expense growth. So we're still underwriting 2% expense growth in our model. Aside from property taxes, we grow at a faster rate based on the business plan and kind of our property tax consultant's guidance. So, I mean, obviously inflation is a lot higher than 2%. So you could make the case for using a higher number, but the same could be said about rent or income. So we keep our rent growth at 3%. So it's 3% over 2%. And if we were to do something like 4 over 3 or 4 over 4, it would be more aggressive actually than 3 over 2. So it's kind of a function of, should we try to be more accurate, or should we just be more, should we stay consistent, and should we be more conservative? Because even if and obviously you could make the case, well, you should have 3% rent growth and 5% expense growth or something like that. But, we're in the business of doing deals, so we're not going to do that. Bo's asking about Houston and DFW and then other markets. So no, we're only interested in these 2 markets at the moment. That's all we're looking at. Okay, what else we got?
Oh, the kind of box thing, bit off spread. All right, what these 2 maps here. So
yeah, we pretty much got there somehow. We covered everything pretty much.
I guess we see cap it. So, I mean, we kind of reiterate the issue about levered on levered IRR, with cash flow constraining, that our IRRs are higher because, the cash flow is not the constraint and not the IRR. So, and I guess also is this CapEx number. So, there's this talk of inflation, everything or whatever costs going up. And, we are doing that, here you can see, last quarter we were at 7,000 for CapEx budget on average, and now we're near to 9,000 on average all in. So, that's reflective of the cost increases we've seen, as well as to some extent maybe that, deals remain difficult to do, but how do you make a deal work when nothing else is giving? Well, you just have to do more. And so that's what's going to support that as well.
Yeah, finding good locations, finding good assets where it makes sense to invest more into it in order to get the return you need. Like Charles said, is pretty much the only place left to generate return. Yeah, so that pretty much covers it. We kind of touched on this, but this is a very interesting chart. So if if you want to spend more time, or you can go back and watch the replay of this, and you can take a screenshot or whatever you want to do. But yeah, definitely encourage you guys to download the spreadsheet. Again, you can go to our website, LSCRE.com. It doesn't say that it's the trade tracker, right? It's the underwriting model download. But when you download that model, it comes with this spreadsheet as well. And this is project level IRR, right?
Yeah.
Yeah.
Right. So the 15 is not, it's like a net 10 or something.
Yeah. So the average deal, right, is kind of like, so when, it's a sad thing to say, but the reality is all of us getting deals in our inbox saying, oh, this is a 19% IRR. It's a great deal. It's a great deal. At the end of the day, the average, in our opinion, our very humble opinion, the average IRR in the market on a net basis is about a 10% IRR. So it is a very, very special deal to be able to push into the high teens. And that's just the reality. The reality is most deals have a low return. That doesn't mean they're bad deals. It just means that people's expectations are too high, and that hopefully maybe one day investors will get comfortable with lower returns, but we'll see. Probably not. All right, that wraps it up. If there's more questions, we're happy to stay on through the hour. If not, we can wrap this up early. I appreciate you all sticking around to the end. It was, as always, a very good discussion. So Bo's asking if those deals that have low returns actually trade. Yeah, absolutely.
Well, someone just says it's a higher return.
Yeah, no, all these deals trade, but when they go pitch these deals to their investors, they don't say that it's a 10. They say that it's a 20.
This is like an underwritten IRR, right? So like in practice, many people who bought supposedly bad deals a few years ago are doing great because the whole market's gone up. But like, that's generally not a great way to try and pick deals.
Yep. That's for sure. That's for sure. Good question. Good question. All right.
Okay.
Yep. If there's no more questions, we'll wrap it up. If you have more questions, feel free to email us. And again, you can visit our website for more information, and we'll see you on the next one.